dive right into our main focus point today, which concerns this topic: 5 common mistakes with money market accounts. Now, money market accounts are often viewed as a safe haven for your savings, but they're also surrounded by misconceptions. And these misconceptions can lead to, let's say, less than optimal financial decisions. So today we're going to break down the key features of these accounts, but also highlight the common mistakes investors make when using them. Money market accounts, first and foremost, are deposit accounts offered by banks and credit unions. They provide a mix of benefits like higher interest rates compared to traditional savings accounts, FDIC insurance up to $250,000, and features like check writing and debit card access. These accounts are great for short-term savings or emergency funds because they offer both safety and liquidity. But here's where people often get confused. The first misconception: these are not the same as money market funds. They may sound like they're the same thing, but they're not. A money market fund is a mutual fund that invests in low-risk securities and gives you a return. Unlike money market accounts, these funds are not insured by the FDIC, meaning they carry some level of risk, though relatively low compared to other things you can invest in. Another myth is that money market accounts protect against inflation. While they're secure, the interest rate that they offer rarely outpaces inflation over time. So your purchasing power, although your money may be safe, its spending power may still decline over time. Many also believe that keeping large sums of money in a money market account is efficient, but the reality is it's not. At most, these accounts should only hold 6 to 12 months worth of living expenses for emergencies, if anything happens to you. Beyond that, you're better off investing in diversified assets and getting those higher returns, right? There's an opportunity cost to keeping your cash on the sideline. Now, some assume money market accounts are the best option for all saving needs. That's not necessarily true. While they're convenient, staying in cash for too long, as I mentioned, means that you miss out on that potential growth that you can get from stocks or even bonds that are yielding higher rates. And lastly, there's the issue of putting all your money in one account. It's important to diversify, right? We're not talking about diversification in terms of you need a little energy exposure, a little tech exposure, a little consumer discretionary exposure. We're talking about diversifying your risk. Because the FDIC is only giving you insurance that covers $250,000 per account. If you want to hold more than that, though I don't see why you would, but if you want to hold more than that in a money market account, you're going to want to split across multiple accounts in multiple institutions. Or you better yet, use other financial products that can better protect your wealth. Listen, money market accounts, they're valuable tools, right? For short-term savings, for stability, for the liquidity, to have money immediately when you need it, but you need to understand the limitations. And understanding those limitations will help you understand how to better diversify your financial strategy, which can help you better achieve your results in the long run.